Good day, family. Welcome back to this new video, and it is your boy once again, Legit Paul. So guys, as you saw the title, this is the part one of the other blog mentorship. So basically, it's not even a mentorship, guys. It's just not even a mentorship. It's like a playlist that I'll create for you all, which is going to be free for you, because even if as you're watching now, you know it's free. It's on YouTube. So guys, I'm just going to make it free for you so that you may have a better understanding of other blogs. First things first, you've been watching my videos. Even if you're new, don't worry. But to those who are watching my videos, you know that I've been using some smart money concepts, Wyckoff, institutional trading, institutional candles, and all those kind of stuff, you know. So but surely a lot of y'all do not understand why am I placing certain stuff on certain places. Okay, and I usually speak those kind of terms, whereas I call them and I say this is an other block and all those, but sometimes many of y'all do not understand what do I actually mean. And to all those who are new, please go back to other videos to see how I please watch this video, then after it go back to other videos and see how I was analyzing, how I was making breakdowns, also using what other blogs. Then you have a better understanding and you'll have more examples of what I'm speaking about. Okay, so welcome guys, welcome. Please don't forget to hit the subscribe button, and even if you are new, please hit the subscribe button. It's about to be heated, it's about to be great. So and also please give this video a thumbs up. Don't forget to share it with your friends and family. Guys, I really appreciate your support. Please do the most, guys. I appreciate your support. Don't forget to comment down below and tell me what you think about this video. And yes guys, like I've been getting a lot of love from you guys, so I really appreciate it, guys. Please share it with your friends and family so that they may have the knowledge that I'm sharing also. Okay, so okay guys, we are about to start. So this term other blogs, okay, other blogs, there are many other terms, but we are speaking about the same thing. It's called an other blog or an SC, which is called sponsored candles. So it doesn't matter what you call it. It really doesn't matter what you call it. What matters is how to use it. Okay, so what is an other blog? Okay, basically this whole thing, I'm just gonna make it so simple for you guys. I don't want to make it so hard so that like I may use those bombastic words or I may make it look so smart or anything. My goal here is to actually teach you guys, is to educate you. Okay, so I'm just going to make it easy for everyone. So basically these are areas of supply and demand. I hope you all know supply and demand, but these are areas of supply and demand, and institutions have placed large orders on these places. So there are places where we can place our orders from. Okay, there are places where we can place our orders from, and they're very powerful. They've worked a lot and they're still working. So okay guys, we have a bullish scenario and we have a bearish scenario. These are the only other blocks we have. Okay, we have a bullish ones and we have some bearish ones. Okay, so basically an other block, it's the candle before a major move. Okay, example, it's a bearish candle before the bullish impulsive move, or it's a bullish candle before a bearish impulsive move. Okay, I hope you understand me, guys. I hope you understand me. So basically this is what I'm basically saying. I'll show you the examples on the charts, but here is just some practicals. So okay, over here we have a bearish candle. Okay, we have a bearish candle. It is the last candle before this huge move. Okay, it is the last candle before this impulsive bullish move. This impulsive bullish move on the chart, this doesn't mean that you must get this one long candle. No, there will be many other candles that are long. But one thing you must keep in mind is that this is what we call engulfing candles. This is what we call engulfing candles. Okay, so basically, for you to say this is a valid order block, I'll just get into depth in more episodes of it, but for now these are just some basics. So for you to say this is a valid order block, there must be, this candle must impulse up and break the previous candle, which makes it what? Which makes it a engulfing candle. Okay, even on this part, this bearish move must impulse this previous bullish move, so that you may say this is what? A valid one. I will go in depth, whereas I'll show you other verifications of what you must look for to say that this is a good order block. Okay, so basically this is just what? A bearish move before a bullish impulsive move. Then also a bearish candle, a bearish candle before an impulsive move, and here a bullish candle before a bearish impulsive move. So basically what happens here is, when you have a scenario like this, we are excluding this part for now. When we have a scenario like this, we expect the market to come back to that point. Okay, we expect the market to come back to this point. It's either it's on the open of the other block, in the middle, on the, which is equilibrium point, on the middle of it, or just somewhere. But I expect the market to come back to that point to mitigate it, or in terms of retail is to retest it. Okay, so I expect the market to retest it. So there's this example I like to tell people about, which is I think it becomes easier for a person to understand. Okay, so saying that, let's just do this. Okay, so saying that now, iPhones, okay, we're speaking about iPhones now. So saying that there were iPhones, they were losing value. iPhones were losing value. Then this is the point, the last point where the iPhone was cheap. This is the last zone where the iPhone was cheap. Okay, then iPhone value went up. Okay, the iPhone value went up. So obviously you wouldn't know the lowest value of iPhones on this point. Okay, but what does the market do? The market wants to give you another chance. Okay, the market will give you another chance to get that iPhone for that value, for that cheap value. So for it to do that, the market, as you can see, the value was increasing. Here, this is the last lowest value of iPhones, and it just shoot up and increase. So what you're going to wait for is, you're going to wait for the market, or you're going to wait for the owners of iPhone, the iStore, to discount that price again, to come to that discounted area. Okay, because it's giving you that last chance to buy that iPhone with with a lower price. Then when it comes to the discounted area, this is when you buy your iPhone with that low value, and then you make that, and then you've saved a lot of money. That's where you take your entry. Okay, I hope this example helps you guys. It's one of the best examples that I use mostly when explaining this stuff. Okay, same scenario as this one. It's just a same scenario as this one. Okay, so basically what happens are, surely wherever you are, you saying that, so where are we going to place our entries? So I'll go in depth in other videos, but for now, what I always tell people, and a safe area for you to enter your trade is on this level. It's on this first level. So basically, let's just do this. Okay, this is our entry, and mostly you're a beginner. Okay, when you're a beginner, your entry will be right over here, your entry, and this is where mostly the market tends, unless if it doesn't turn here, it turns on the 50% of this candle. Then your stop loss is over here. Okay, your stop loss is over here, but the challenge that we have is that Since while we are using MetaTrader to take our trades, or any other platform surely that you use to take your trades, or broker, I can say, it has spread. Okay, it has spread, and I don't know how much spread like your broker have, but most of the time you find that the spread is on about 5, 15, and all those kind of numbers. Okay, so you find that your on the market, your trade did not hit the stop loss, but just because the spread was high, the spread hit your stop loss. So most of the time I like to tell people that they must put it a bit lower. Okay, or over here your entry is going to be over here, your entry is going to be over here. Okay, your entry is going to be here and your stop loss is going to be here. Okay, so your entry is going to be here and your stop loss is just going to be here. Stop loss will be just above. Okay, just about 2 pips above, or about 3 pips above, just to be safe. And I don't want y'all to risk a lot, because I don't risk a lot. Then when your trade comes to this point, okay, maybe you placed a buy limit. Maybe you placed a buy limit, which is what I always recommend. Then your stop loss is just around here. Keep in mind, guys, this is an example. On the real chart, the stop loss will be much lower. So okay, then your trade is up there. Then your stop loss must be at least below a bit, just below a few pips. Then you take your trades. First take profit will obviously be maybe over here or past there. We will look at mostly the structure of the market. We'll go with the structure of the market in terms of like where you place your target. Then here it is, guys. Here it is. You are securing. Even on this part, you take your trade from over here, saying our minimum take profit is over here. Then our stop loss is over here, just above. Okay, so guys, this is the practical. Actually, this is just a few. It's more practical. I hope we understand this practical. Now we are about to go on to the real chart. Okay, perfect. Okay, guys, now we are on the real chart. On the real chart, now we're going to spot some other blocks. Okay, we're going to spot some other blocks, and you must keep in mind that not all other blocks will play out. Okay, in other episodes I'll show you, because always on the market there's other blocks. There's no way that there's no other blocks on the market. The market is always issuing other blocks. Okay, but that doesn't mean that you must go with every other block, because that's where you will just, because in that way you'll be lost in the sauce, guys. You will just be lost in the sauce. Okay, so I'll just point out one over here. Okay, but this one is some one I wanted to show you onto the other episode. I want to show you this one onto the other episode, guys. Let me show you what I'm speaking about. Okay, let me remove this. Okay, guys, you're going to find situations where this bearish candle before the bullish move, it takes about 2 bullish candles before it can go up. So in this way, I'll show you in the other episode. I don't want to confuse you all now. I'll just make something onto the next episode. Okay, so let's just look over here and see if we can find something. Okay, guys, over here we have an order block. Okay, we have an order block. Perfect. Over here we have an order block. So I just want you to see clearly. I want you to see clearly of everything that is happening. Okay, we had a bit of a small bullish move, which created some impulsive move, and created some bit of corrections and went up. Over here we had a bullish candle. Okay, we had a bullish candle. Then after this bullish candle we had a bearish move. Okay, but another thing that I want to show is that I used in Crow FX, there is what we call an Crow FX refined IFC, or we can say Crow FX refined order block. Okay, whereas it's in a situation when we have a candle like this, a big candle like this, this one do not actually engulf, but there is a bearish move, we use the next candle as what, as our order block. But I don't want to get deep into that. I don't want to confuse you all. I'll do it onto the other video. But for now, here is our order block. Okay, as you can see guys, we had a bullish movement. Before this bearish impulsive move, we had a bullish candle, which is our order block. Now we draw our order block. Then the market went down a bit, and what did it do? It went up to mitigate. It went up to what? To retest the order block. And this is where we enter our trade. This is where we enter our trade. Our stop loss can be a bit above 15 pips stop loss. In smaller time frames, your stop loss will be a bit more, even lower. It will be about 3 pips, guys. So like, it's just going to be fire. Then your first take profit can be over here, which is 1:3 risk ratio. Then you can just go a bit down. Okay, so from there to here, you can see we had about 114 pips, 1:7 risk ratio. So let's just go to the next example. Our next example is over here, guys. We had a bearish move, and before this bearish candle, we had an impulsive move. So this, what does this mean? We use the Crow FX refined IFC, because this one is way more bigger than this one, but I'll go in depth in other videos. But here is our order block, guys. As I told you that sometimes the order block won't hit right at the top, but it will take about 50% of the candle. Okay, so over here it took what, 50% of the candle. So the market went up. Okay, after this order block, it went up, then it came back to mitigate, then truth to the upside. So we take our trade from where? From over here, because this is where I told you to place your entries. Your stop loss becomes just over here. Okay, then your first take profit will be just around here. Okay, 1:3 risk ratio. Your first take profit will be over here. Perfect. So let's just go to example number 3. Okay guys, example number 3 is much more precise. It's much more precise. Example number 3, we had a bearish move, and before a candle we had a very impulsive bullish move. This is what I've shown you where on the practicals. This is exactly what I showed you there. I showed you there. Then what you do is what? Is draw your order block. Okay, perfect. So we had what? We had a bearish move, and this bearish candle before the what? The bullish impulsive move. Then the market, what did it do? It came and it came to retest this area. And in institutional terms, we call it in institutional trading terms, we call it mitigation. It came back to mitigate this area. So by that, we take our trade from over here. It also mitigated the 50% of the candle. Stop loss just around over here. Our take profit on the last structure. Okay, so it's how much? 1:2. So guys, this is okay guys, this is example number 4. We are on GBP USD now. USD had no beautiful setups for me, so this is the trade that I took on GBP USD. As you can see on the first, let me do this, we had a bullish impulsive move. Okay, before that, after this bullish impulsive move, we had this a bullish candle before what? Before the bearish impulsive move. Okay, which is what I've shown you on the example. So what we do over here is what? We draw our order block. We draw our order block from there to here. So look at what the market did. It went down and corrected upward to this order block, to what? To mitigate it, or we can say to retest it. Then we take our trade from here. Okay, we take our trade from here, and our first take profit can be over here, but as you can see, my first target was over here with my analysis. So 1:7 risk ratio basically. Okay, so this is how actually you trade using order blocks. Okay, so let's just do that example last more time, that example of the iPhones. Okay, or you can take it in terms of shares. Okay, you can take it in terms of shares, whereas you bought Apple shares. You bought Apple shares were increasing, were increasing to this point. Then you had this massive downfall, and you can see, okay, now you can see now that thing is about to get down. This thing is about to get down. I'm going to lose my money if I don't sell my shares. If I don't sell my shares, I'm going to lose my money. But what does it do? The market will let you first. It will give you the chance to close what, to sell your shares at the point whereas the market has turned. So what does the market do? It takes you back to that point, whereas this is the last point, whereas the shares about to go, the market is about to go down. The market of Apple is about to crash. Okay, so this is the last point and the best point, whereas you can sell your shares. Okay, then you sell your shares over here. Then now we place our we sell our shares from over there. I mean, we sell our shares from over there. Then you are good. You are making your money. Then you are out of the market. So let's just go deeper. Let's just go deeper, because over here we have an order block. As you can see over here, guys, we had a bullish move. So before this bullish move, we had a bullish candle before the impulsive move. So what we do, we use the refined way, whereas we take this order block, we take this as an order block. Then what happened? The market went back again to give us an entry. Then we take our trade from over here, then down to here. Okay, down to this point. Then we have another one over here, whereas as you can see, the market was going down. The market went up. Before this bearish impulsive move, we had a bullish candle. This bullish candle is now what? Is now our order block. Then what did the market do? It went up again to mitigate this area. This is where I took my first trade. Then I went down with it. This is where I took my first trade. Then the market went up again to this point, whereas we had a very bullish impulsive move. Okay, on this point we had before this bearish impulsive move, we had a bullish candle, but we used the refined way because this candle is longer than this one. It does not impulsive. We use this one as what? As our order block. Then look at what the market did. It went down, then it went to mitigate to retest it, and this is where I entered my second trade. Then look at what the market did. Look at what the market did. Look at what the market did. Truth, it went down. It went down. It busted down. Over here I missed this entry, but over here, as you can see, bearish impulsive move, we had a bullish candle, which it's now what? Our order block. After this bearish impulsive move, look at what the market did. It went in mitigate or retest this order block. Then we take our other entry to the downside. Okay, we take our other entry to the downside. So guys, this is how actually order blocks works. I hope you understand. When we go to other videos, you'll be able to get a more precise knowledge about order blocks. This was just the beginning, and please, whoa, wait a minute, guys, wait a minute. I just saw a very beautiful order block that I wanted to show you, and I will never let it go. Okay, so over here, guys, look at what we had. We had a bullish impulsive move. Okay, we had a bullish impulsive move. Then before this bearish impulsive move, we had this bullish candle. Okay, but can you see what it does? Created. So we're just going to use the refined way. The refined way tells us to use this candle. We use this candle, and look at what the market did. The market went down and came and mitigated it, and what triggered our sell limit, and we are now in the trade. Then this one mitigated this this long week, because in smaller time frames, in this long weeks there is candles. So this one was mitigating the weeks, and we are already in the trade. look at what happened. Truth down. Look at what happened, guys. So okay, do the most, guys. This is the last example. I'm out. Guys, please, if you do not like this video, please give it a thumbs down and tell me why you did not like this video, so that I may be able to upgrade. Okay, and please give this video a thumbs up if you liked it. Comment down below and tell me what you think about this video, how it has helped you, and how has the knowledge kept you, how has the practice went. Okay guys, I'll also do a giveaway when we reach 1,000 subs. Okay, I thank you for reaching about 80 something subs right now, but we're still going, we're still pushing. If you can share it on your statuses, on your Instagram stories, and everywhere, you can even tag me on Instagram. Please follow me on Instagram. Please do the most, guys. Please hit the subscribe button, and I hope you enjoyed this video. It is your boy once again, Legend Paul, and I'm signing out. Yes sir.